Thank you for joining me. I'm Alex, and I would like to talk to you about AMC Entertainment. So, what they do is they have movie theaters, and some of the biggest ones in the country. They're actually international, so they have movie theaters not only in the US but also elsewhere. And they have 22 of the 50 biggest movie theaters in the US. So, their price currently is $10.82, which is up slightly or break even pretty much. And the PE is negative 15, which means they're currently losing 62 cents per share. But they actually make a profit, which is funny because you don't see a lot of companies like that. So the dividend yield is 7.4%. And the payout ratio is over 100%. So earnings per share are calculated less dividend. So it means the profit minus the dividend, which means that they're losing money EPS, but they're actually profitable before paying dividend, just not profitable enough to still be profitable after paying a dividend, which means that they're paying over 100%, really. I mean, it's got to be close. So revenue $5.5 billion, which is up 10%-ish. Earnings $110 million, which is up from negative $500 million the previous year. But the year before that was almost exactly the same as the last year, and the year before that was again pretty much the same. So except for the last year, they've been fairly consistent, which is a good sign going forward. But obviously, a negative EPS is still a problem. So total assets $9.5 billion, which is down slightly. Total liabilities $8 billion, which is up slightly. Pretty much what you can expect when you're losing just a little bit of money. And net tangible assets of negative $3.8 billion, up from 3.6-ish. So to sum it all up, obviously, for a growth investor, neither the revenue nor the earnings growth is really good. So growth investors are out. Dividend investors, I think, have an interesting stock, but I don't think that you should buy it anyway because of, first of all, the net tangible assets, and second of all, the payout ratio is pretty much 100%. So I don't think there's room for growth of the dividend in the future. And I don't think that without any major things happening, you can get your share price back as a dividend before the company goes broke or increases their profits or makes any other moves into the right direction. So I don't think that currently you should buy it as a dividend stock, and I don't think that it really makes sense before anything major happens to the company. For a value investor, PE is terrible, obviously. Net tangible assets or the whole balance sheet is terrible. The dividend yield is obviously nice, but can't make up for that, and I don't think it's a safe enough stock, all things considered. So I kind of don't recommend buying the stock to anyone at this point. The most important thing here is that I don't think that there's much growth to be had in the movie theater space, which is their main business. There's a lot of families ever since the Great Recession that have been going to the movies less, and there's obviously the outrage that small popcorn costs you $49 a person. And so I think that the movie theater space will not be where it was unless we have a huge growth in income for the median family. So if there is no recession next year, which I assume there won't be, but no one can predict that, then I think there's hope for the stock. If there is a recession in the next couple years, then I think that they're going to be very close to bankruptcy, and I think that they might even go bankrupt and maybe get bought out by a bigger company, or just have to close up shop. So that's why I don't think that anyone should be investing right now. That's it for me for today. If you haven't already and you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.